Good morning. Can everyone hear me in the back there? Very good. My name is Joseph Weglarz, and I'm going to be the host this morning for the UDM 2015 Symposium entitled The Illusion of Prosperity, Economic Recovery, Fact or Fiction. I would gather that most of us in the room would say that it's more fiction than fact. On behalf of my colleague, Harry C. Breiser, the University of Detroit Mercy Department of Economics, the UDM Economics Club, Michigan Council on Economic Education, the UDM Center, and our distinguished speakers, Professor Matthew Fisher, Assistant Professor at Ivy Tech Community College, Professor Joshua Long, Associate Professor at Indiana Technological University, and Mr. David R. Bruhan, Vice President and Portfolio Manager at Gregory J. Short and Company Incorporated. Again, I would like to thank all of you for taking time out of a very busy Saturday. I know all of you have other things to do, and of course the weather isn't as great as it was a few weeks ago, but thanks again. Over the past 8 years, the University of Detroit Mercy has been offering undergraduate and graduate courses in economics at Macomb University Center, and the Symposium series is just a small part of really what we do here. And the Symposium series, which we put together 8 years ago, was an attempt to bring the community together and develop a conversation about economic topics. And we've done that, and every symposium we've been blessed with lots of people, lots of questions. So we want to keep the conversation most certainly going. So as I mentioned up on the slide here, we want to continue that conversation here at the University of Detroit Mercy. One of the most exciting developments over the last year, and some of you who were at the last symposium heard me speak about this, is the development on the undergraduate side. And that is the recent granting by the University of Detroit Mercy of 96 transfer credits from Macomb Community College. Now that's just not the center campus, it's also the south campus. And if you know anything about students walking out of university with huge amounts of debt, this is a huge opportunity for folks to stay here in the community and get a quality education. So really what this does is it leaves only 10 additional courses for an undergraduate here at the university. And if you think about that, you think about private education, we have an extremely competitive tuition here at $5.16 a credit hour, as opposed to other private schools around the state of Michigan. So I can really truly say that this is the best deal in town for private education here in Macomb County. So I would hope that you could pass the good word around to your neighbors and friends and see if they're interested. The other side of it is really what we're developing is what's called a 3+1+1, which is a Macomb Community College student coming here at the University Center or from South Campus and partaking of 10 courses, 30 credits of undergraduate work, and going ahead and taking additional 10 for a sort of accelerated master's degree in financial economics. And again, this is at an extremely competitive rate for a private education, $7.79 per credit hour. And what's interesting is Professor Breiser and myself and Professor D. Giovanni and others have seen the graduate degree as a springboard, not only into teaching, but into numerous profit corporations, public sector jobs, and also advanced graduate work at other universities. So as I said, I think at the last symposium, part of our job is to impress upon all of us that economics, and I think in the last symposium I said it was the best of all possible disciplines. So I re-looked this and I thought, well, it is one of the best of all possible disciplines to study. Not only because I think it provides everyone with a more complete understanding of, as Jude Winitsky said, the way the world works, but because I think it's just so darn interesting. Every day, something in the paper, there's something you hear, you think, wow, this is just unbelievable, what has just happened, or can you believe what Janet Yellen didn't do, right? In 1890, Alfred Marshall wrote his Principles of Economics, and I used this in the last symposium as well. And he said, quote, "The economist needs three great intellectual faculties: perception, imagination, and reason. And the most of all he needs, or she needs, imagination, to put him on the track to those causes of visible events which are remote or lie below the surface." And hopefully this morning we will be able to at least begin to explore that whole area. So it is the use of this imagination, I think, although we don't know what the future is going to bring, will give us a path to understanding a little bit better whether or not we are on the road to economic recovery via fact or fiction. The next symposium is going to be sometime this spring. I don't know yet. But we will have another one. So I think from now on we're going to see a fall-spring symposium series. If we don't have your email address, you can run up there and give it to us, and we will make sure that you get information on the next symposium. One other housekeeping note, we'll have a short 10-minute intermission after Professor Wong's presentation. And after all the presentations, we'll have a question and answer period, so we're going to try very hard to keep the conversation going, but also have enough time for everyone to ask as many questions as they want. And then finally, please hang around. We have our traditional drawing of stuff that was in my closet in my basement. So send those things your way. The Federal Reserve, so my short talk would be simply, the Federal Reserve is at a crossroads. But then you would say, Weglarz, the Federal Reserve is always at a crossroads, which is probably true as well. It is true that in the 102 years of its existence, it has faced many challenges, surpassing expectations in some instances, in the minds of some, but also disappointing many throughout its history. In fact, its indecision over a federal funds rate hike over the past year and a half has consistently rattled the capital markets and has caused many to question its very existence. Although the rate hike on December 16th is not out of the question, will this lead to a bona fide prosperity somewhere down the road? Is this the golden bullet, that's going to pierce the economy, and all of a sudden we're just going to walk hand in hand in paradise, right? Or are there structural, monetary, and regulatory issues that really prohibit a sustained period of economic growth in the near term? Now, theoretically, the Federal Reserve steers the economy with the federal funds rate. This is the rate charged on overnight loans between banks. If the economy is perceived by the Fed to be growing too quickly, it raises the rate to dampen the party. If it perceives a sluggish economy, the opposite is enacted. That is, a rate cut is called in to prevent a recession. But again, as all of you know, it's not that simple. The rates on longer-term bonds, the risks perceived by prospective bond buyers beyond the Treasury bill rates, the liquidity of the marketplace or the illiquidity of the marketplace, the willingness on the part of banks that are willing and able to lend and lend freely, the prevailing value and the strength of the dollar, the effects of the falling prices in petroleum, and the quote-unquote, the condition of the equity markets. are important factors in time and place that the Federal Reserve must take into consideration. The period from 1982 until 2007, that period that was dubbed by economic historians as the Great Moderation, was not only a great facilitator of financial innovation and risk-taking, but was accompanied by the conspicuous absence of any real inflation or a bona fide recession. The creation of an artificially induced prosperity encouraged businesses, entrepreneurs, investors, and banks to take on additional risks based on the assumption that the party would never, ever end. In response to the drop in the housing market in 2007 and 2008, the Federal Reserve aggressively slashed the federal funds rate from just over 4% in 2007 to just around 0% in 2008. And there it has stuck. Right? It's been there ever since. Although rates have been aggressively adjusted downward in a hurry, confidence in the financial system waned, and all of a sudden what? Credit began to tighten up. With nowhere to go, and the economy barely responsive, the Federal Reserve under Ben Bernanke, who in his book had the courage to act, right, embarked on a series of bond buying programs known as quantitative easing, promising to maintain the federal funds rate near zero, holding down long-term interest rates, while at the same time hoping to spur on long-term investment. As all of you know, didn't work this way. The Federal Reserve is again at a crossroads. George Ip astutely summarized the Fed's new predicament recently in the Wall Street Journal. He said this: nearly 7 years of zero rates and a $4.5 trillion balance sheet have nurtured an expansion that, at 75 months, is the fourth longest since World War II. It has also encouraged investors to pour money into emerging market bonds and other risky assets, end quote. But at the end of the day, it doesn't feel like prosperity. In fact, according to a recent Labor Department report, quote, U.S. worker productivity is advancing at one of its worst rates on record, said Eric Morath of the Journal a couple of weeks ago. Quote, frustrating prospects for a sustained economic acceleration more than 6 years into the expansion, end quote. With the consumer price index falling to a seasonally adjusted 0.2% in September, with gas prices falling roughly 30% this year, with consumer prices being held down by a strong dollar, making all imports cheaper for Americans, and with unemployment in check, and I put that in quotes, in check, but the participation rate is not in check. In fact, that rate declined in September to 62.4%. This is the lowest participation rate share since 1977. So here, Janet Yellen's Federal Reserve is poised to act, or maybe not. And we can argue that indecision is contagious, especially at the Fed. The most recent Federal Reserve Board minutes, Sam Fleming of the Financial Times of London reported just a couple of days ago, quote, exposed continued divisions among Fed policymakers with some warning that it was unlikely that information available by December would support an increase. He went on, he said, they questioned whether the U.S. economy was strong enough to withstand a sudden setback given the Fed's limited monetary firepower at a time of ultra-low interest rates, end quote. Whether or not a rate hike is enacted in December is really not the most important question. The most important question is this: is prosperity really around the corner, or is it simply an illusion? So our presenters this morning will plumb the depths of this question with an analysis of the real and identifiable effects of interventionism in the economy, an update on what the Federal Reserve really is doing in the area of monetary policy, a global overview and prospects for future economic growth, and recommendations on how to return back to monetary sanity through the reintroduction of the gold standard. And you know who's going to speak on that.